I'm Sue Moss, as you know from my previous video if you've watched that one. This section is about the changes that are happening that prevent accountants from helping you in the future. On the 1st of July 2016, we will not be allowed to say something, but we can say it now, and I'll turn on the TV to show soon what that is that I can say now. But I want to set the background. Basically, from the 1st of July 2016, to gain a limited license to talk about financial products such as superannuation, insurance risks, they're the things that I'm interested in anyway. So there's a lot of financial products out there. To gain that right to talk about those, we have to apply for a limited license, or we have to pay a lot of money per annum to work under the different institutions that are available for us to work through. And it's just not worth the amount of money it costs us and compared to the amount of money we could possibly make to bother doing that. So, yeah, unless it's a big practice, I'm sorry to say, and mine isn't. So I can't give you that advice from the 1st of July. I can give it now, but the reason is that we won't be able to be licensed because from the 1st of July they're taking away the accountant's exemption from having to gain experience working for a licensed financial advisor. So we will have to stop practicing as accountants for a few years to work for a licensed financial advisor so that we could come back, build up our practice again and give advice that is restricted and has to be licensed. At the moment, we don't have to worry about the experience. We just have to abide by set regulations, and there's a whole lot of do's and don'ts at the moment that I can talk about and that I can't talk about. You won't be able to read it from there, but these changes have brought to our notice a lot of things that we thought we could say, but we now realise we can't. When the changes came in 2001, we learnt that we could still continue to talk about property and interest-bearing accounts. We could give advice on that and be specific. But no other financial product are we allowed to be specific. We have to give general advice that relates to tax and factual information and broad category investment wise advice, like this piece of advice that I learnt as an accountant. It's if you don't want to get hit badly by the possibility of a massive drop in the share market, you put your money in on a monthly or weekly basis into, say, managed investments. You don't, just because it's sitting there from, say, the sale of a property, doesn't mean you should transfer it straight away. My mum had a whole lot that she was going to take advice from Your Money financial advisors and put it in all the different places like I was doing, and she decided that she should just, because it was sitting there earning only X amount of interest, she should put it all out at once and put it in. And I said, Mum, that's not a great idea. You should spread it over time so that you don't get hit by a downturn in the stock market. She said, it doesn't make sense, Sue. It doesn't make sense. She didn't listen to me. She sent off a cheque, and within 2 weeks the share market dropped by 10-15%. So she lost that instantly on all that money. Fortunately, I used my own advice and put mine in gradually, so I didn't get hit so badly like she did. So that's a little piece of information we can tell you, and it's broad category, and it's just wisdom. There's some things that I wish I could tell you, but I've just realised that I'm not allowed to tell so many things. It's really odd. I can advise a self-employed person about one of the best ways to save on taxes and provide for their future, but I can't tell an employed person. The law just prevents me. It's just ridiculous. I'm sorry. Some things really bug me about these laws that politicians have set up, and I'm not going to speculate as to why they're set up. Anyway, I want to tell you one thing before I can't tell you any longer, and it's something that both myself and a friend who runs a large practice with employing quite a lot of accountants, he's always given the same advice. It was great to hear that we both have the same figure in mind. So I'm just going to first of all prove that it's not after the 1st of July, so I'll turn on the TV, and today being the 20th anniversary of the Point Arthur massacre, means that that's what's running in the background, the Port Arthur massacre. So this is the 28th of July 2016, and that's part of the service. I'll just put it on mute now. What both Fred and I generally have told our clients in the past when they've asked us whether it's a good idea to set up a self-managed superannuation fund is that they're quite expensive to run, and they require a fair bit of skill, and you need to be someone who likes the idea of choosing what shares, what managed investments, where you want your money to go. And you've got to be watching it quite regularly, because you don't want to leave your money in somewhere when it's going to keep going down and down and down. You could pull it out at a certain point, wait for it to keep going all the way down, and then put it back into that area if you still think it's a good area to put it back into, and then catch it on the rise if you've done your homework and you've watched it well. And that's what a financial advisor should be doing. And they should be protecting us from those massive downturns that sometimes clients take. Anyway, setting up a self-managed superannuation fund, because it costs so much, that cost takes away a percentage of your earnings. So Fred and I have often said to our clients who've asked us this question in the past that you want to have about $200,000 to transfer from somewhere else, whether it's the sale of a property or your existing superannuation funds, across to a self-managed superannuation fund to make it worthwhile paying for your accountant who does the bookkeeping for a superannuation fund, and the independent auditor who has to charge a fee for his services. And his services are quite expensive because he's got high professional indemnity insurance to protect himself from doing the wrong thing. He's got high overheads and he needs to charge a significant amount too. So generally a self-managed super fund, well, my clients, no, I won't say this, but often the fees are around $2,000 per annum, I'll say that. My clients don't always pay that much. Some of them pay more because they have a lot of transactions going through their super funds. And they do that because they love investing in different areas. Okay, so that was the tip I wanted to pass on, is the 200,000 threshold and the $2,000 of costs. Now, the ATO website will advise you that those costs are significant, and it's quite often not worthwhile doing, but they don't lay out the actual figures that are a reasonable guide. And you must remember that a self-managed super fund is set up for the sole purpose of providing for your future, so you're not allowed to benefit from it before you retire. So you can't invest in a holiday house, something that you will use. You can't invest in property that you're going to use for less than the normal market leasing or rental costs. Your family shouldn't benefit from it in any way prior to your retirement. It is set up for that pure purpose. So a lot of people who've asked me in the past whether it's a good idea have asked, should their self-managed superannuation fund invest in property if they were to set up one? Well, I'd like to pass on to you this, and I think I'm allowed to do so, going by the regulations. I think I am. Basically, a seminar I went to was run by an accounting firm that regularly set them up for self-managed super funds up for investing in properties. And what that advisor told us was that only 6% of people who look into doing this decide that it is worthwhile doing. And I can tell you from what he said and from the experience I've seen of looking after a client who's done so, there's a lot of extra costs in relation to banks, the extra fees that they continuously charge for having that structure doesn't necessarily make it a great, doesn't necessarily make it really good idea. And of course it can't be negatively geared within a superannuation fund. It's not allowed to be. So you may be saving a lot of money on capital gains tax for the future by having the property within the self-managed super fund if you plan to sell that property, but you may not. It's hard to know whether it's going to be worthwhile in the long run. It really is hard to know. You'd have to do a lot of work analysing that, and you need a lot of money behind you before you can invest in a property, because you can't allow it to be negatively geared. Generally, this particular advisor that ran the seminar I'm talking about said you need about a third of the value of the property so that it's not negatively geared. There you go. That's just a little tip I wanted to pass on. But my main reason for doing this video was, again, in the beginning, please petition the politicians to allow accountants to help our clients in the way that we've done in the past. I hate the idea of this. Look, I'm supposed to pull out of my pocket every time a client asks me a question, a disclaimer, and hand across to them. Like, I'll answer a question when I'm in at a business, and the client will ask me something simple about his superannuation, and fortunately so far I've only given tax facts and so on, and I've been careful, but I've meant to add all the time this disclaimer and pull it out of my pocket in writing. The law doesn't say I have to put it in writing, but my professional the professional regulations require it, that I abide by anyway. And that's a disclaimer, and it's valid. I am not licensed under the Act to provide financial product advice. Taxation is only one consideration when deciding on a financial product, and you should consider seeking advice from an Australian financial services licensee before stumble on my words, before making a decision on a financial product. There you go. And fortunately I haven't got a cold, so if I handed that to you, my tissues would have been clean. There we go. I think it's a bit ridiculous, to be honest. I often say that, but I don't want to have to carry around these in pockets, so I've got them whenever someone asks me a question. Oh, it means you've got to wear pants all the time, not skirts as well, so that they're on your body and you can hand them across. Yeah, look, I want to tell you one other thing. I do not want to be licensed as a financial advisor. I don't want to give specific product advice, and most accountants are like that.